Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, because I help you find ways to save money and perhaps make money in the world of finance. Tonight we're going to be talking about relative strength. It's a pretty good indicator, I believe. I use it in conjunction with Bollinger Bands. And it's interesting. I'm going to show you the math and how it works and how you want to use it out there in other ways as well. Be sure to subscribe, get notifications if you're interested out there. Look in the notes for links and websites, also tending to put it at the end of videos now. And check out the books in our bookstore. There's a pretty good one on relative strength as well. So it is a momentum indicator. Other people say it's not up and down days, but to me, what you're looking at is the number of up days versus the number of down days. That's different in that Bollinger Band is looking over a 30-day period and how it varies from a mean, a moving average. Relative strength is simply looking at a 14-day look at up days and down days. It is to some degree a regression to the mean as well. You will not have buy forever and sell forever either. And so it does tend to regress to sort of a no man's land the way that Bollinger Bands do as well. It has a range of 0 to 100. It's also a moving average, and we'll see that when we calculate it tonight, that you use a 14-day, and then tomorrow you'll use a 14-day, but drop what would be now the 15th day and so forth. It is based on price changes, simply up or down, gain or loss day to day. Developed by a guy named Wilder back in 78. And it does have overbought and oversold. Now, what that looks like depends upon how you have it set up. When you go into places like Yahoo Finance and so forth, they tend to use an 80-20, but I don't think that is very realistic. I tend to use 70-30, and I'll show you what that looks like as well. But you can actually adjust the number of days, and sometimes it's something that I do in certain things that I model. So, anywho, how do you calculate it? It is 100 minus, in parentheses, and the order of operations matters, 100 divided by 1 plus RS. So how do we find RS? I'll show you down here in a second. It does tend to work best in sideways markets. Just like with Bollinger Bands, you get this climbing, and it doesn't tend to do as well. And you get this falling, and you end up having a dollar cost average. But at any rate, it is RS, relative strength, is the average gain over the average loss. So how do you find that? For the average gains, is some of the gains over the past 14 trading days, typically periods, you could do less than days, but divided by 14 versus the average loss is the sum of the losses up and down over a period of time as well. So subsequent data points for relative strength are after the first calculations. This is the first one here. Subsequent ones out there drop a day as you move a day forward, and that's what it's trying to say here and why it is a moving average. So here is how it would look like in Excel, and I think that's the best way to calculate it if you're going to calculate it on your own. I do tend to do a relative strength in Excel for stocks that I'm watching, and the reason why is I can see where it is intraday within the day, and it's not as easy to find that depending on which programs you're looking at. It's a little more exact when we get right to the buys and sells, but you can see here is a time period, here's the closing price, and there's the change. You lost 25 cents here, it was up 6 cents here, lost 54 cents and so forth. But ultimately you can see over this time period, initially at least, you have a lot more gains than you have losses. And when you get to the relative strength down here, you'll find out, running those calculations exactly from the previous page, you have a relative strength above 70. And that's what you tend to get, these sort of runs of gains or runs of losses, essentially. Then you turn over and the stock starts heading down and you have more losses than gains, and you can see the relative strength can drop pretty quickly until finally it gets down near the 30s down here. But at any rate, you can set this up in practices and look at it yourself in Excel, but these are the calculations in Excel to get you relative strength. This is what it looks like graphically. Here is the moving prices, essentially, we were just looking at there. And you can see that the relative strength will tend to climb and climb and climb. They did use 70 here. I have a special use for 80 when I'm looking at puts or selling short. Those type things, it tends to be a lot more accurate when the relative strength gets to 80. But at any rate, then you can see it leveled off for a while and it started down. And once again, you'll find that you had relative strength. Now, truthfully, that one is oversold as well, and these are overbought. But at any rate, this is what it looks like visually as you're going through and doing it. If you want to see what that looks like in one of my favorite programs, which is Stock Chart, or Fenviz, I guess, is a stock chart. It is actually a Fenviz in this case. You have a stock here. It is a large technical, or whatever you call it. It's a large, I try not to tell you the names because I'm not supposed to tell you that from a FINRA standpoint, but it is a large company that deals in the tech industry. How about that? And you can see how this is dealing with, I deal with, like I've said before in the Bollinger Band, one's a 13-month period. And you can see that really you don't get many that truly drop below. And that's part of the problem sometimes. You have to look and say, well, maybe that got to 30.2 or something along those lines. But at any rate, you may have sold it here from a previous hold. You definitely sold it when I got to this point. And some would say, hey, I didn't get all this gain. Well, you know what? You didn't get all that loss either. So I would have sold out here and been patient. That comes back to what I think is the number one thing to have as a good investor out there, which is discipline. So when it gets to this point, I sell it and I wait. And you can see I might have bought here and then come close to selling over there. I'd have to go look at the numbers a little more closely. Selling goes over here. And once again, it's above the Bollinger Band and above relative strength. So I sold. You can just say that it's below the Bollinger Band, which are these up here, and below the relative strength where I bought. And so this is another good indication of them trading within ranges between here and along and between the moving average here. But that it does tend to regress back to that average, but it also tends to hit these highs and lows. And truthfully, I may have said this or not before, you know, when I combine these, when I initially got into this was never about buying and selling. It was actually about being overbought or oversold and maybe too expensive to buy and maybe getting cheap enough that I would want to consider buying. And ultimately, if you stand behind analysts and they look at multiples of earnings, price to book, EV to EBITDA, or whatever, when they compare among others in the industry, there's always a price element of it, always. So they can say they don't use it, but in a way they do. This is just another way of formalizing it. Once again, when you combine them together, these were saying buying the Bollinger Band, but not down here. And, you know, ultimately, I think it tends to work better through time. So this is what it would look like if you were actually doing it inside of one of the programs I suggest. So there's a book on it, Technical Analysis for the Trading Professional by Constance Brown. You can go look at the links that we have in here and take a look at it if you want. It's a pretty good relative strength one. It has others in there as well, but it's got a good section on relative strength for sure. From a research standpoint, I pulled up two papers, one of them from Sacred Heart here, one of them from ResearchGate. And if we go over there and take a look at it, you can see the one here from Sacred Heart. And it actually shows you that should individual investors use technical trading rules to attempt to beat the market? Quinnipiac is actually a pretty good university up there as well. It's a 2010, despite widespread academic acceptance of efficient markets, some stock traders still use technical, and they're looking at relative strength down here. One of the deficiencies, if you will, of this study, as far as I'm concerned, when they say trading rules were tested over the years 2000 to 2009, a time period that exhibited bull and bear markets. There was a major sell-off of the bull market in 2001, and over the next 8 years, you didn't make any money. You actually lost money. They typically call the time period from 2000 to 2001 through 2010 the lost decade because you didn't make any money on it. So it's not the best time to test it, to be honest with you, but we tested the 4 trading rules against 576 stocks that comprise the S&P 100, the NASDAQ, and the S&P Midcap. Once again, indices instead of individual securities. It's harder to trade indices because the up and down are wiped out by other stocks. That they said that no one trading rule could consistently beat the market. Then they conclude down here with exactly what I've kind of said all along, which is why I'm working on a very large fundamental analysis. It's something I've done all my career to try to help you guys see. And it says down here, said technical trading rules cannot be used to consistently beat the market. We recommend that investors first use fundamental analysis, accounting and all the rest, to select stocks and then apply trading rules to enhance their potential gains, which is exactly what I would suggest along the way as well. So the other one out here is dealing with technical analysis on the London Stock Exchange. This article examines 2 oscillators, MACD and relative strength, to see if these rules were profitable over a 60-year data time period of, once again, a very large index is what they use. It is found that relative strength as well as MACD rules can generate returns higher than buy and hold strategy in most cases. And just to add a little down here, they talked about using different 14-day and 70-30, 3-day and 70-30. They tried a couple of other technical trading rules. And the interesting thing down here about the MACD and the relative strength is a 0.778% 10-day return, which if you could do that 36 times a year, was a 22% annual profit. And on the ones that found a minus 10-day return on relative strength, that's a 3.3% annual loss. So there is some indication at least that it is helpful. Once again, the strategy tip, and you've heard me say this a number of times, is layer them with Bollinger Band. That's why I gave you the example. And don't forget to send emails and comments. I'm beginning soon to have something called Ask Dr. Frank, and I would be happy to look at your emails and answer questions that you guys have on another video in the future. Next, we'll be discussing Fibonacci and support resistance. So have a great night or a great day, whatever it is for you. Appreciate you, and have a great day.